Your retirement portfolio might be a ticking time bomb, and you haven't even noticed it. Most people think they're safe because they follow the classic 60-40 rule, but the math tells a different story. Think about the last time you glanced at your investment dashboard. You probably saw a neat pie chart, a tidy split between stocks and bonds, and felt a brief surge of confidence. That feeling is exactly what financial advisors want you to have until the market throws a curveball. The truth is, the balance you're holding today could be the very thing that drags you down tomorrow. It isn't just about more stocks when you're young, more bonds when you're old. It's about how life expectancy, income volatility, and the hidden dynamics of interest rates reshape the risk-reward equation at every age. In the next few minutes, we'll pull apart the assumptions you've been handed, expose the blind spots most retail investors ignore, and give you a framework that actually matches the reality of today's economy. Let's set the stage. The 60-40 split, 60% equities, 40% fixed income, has been the default for generations of advisors. It was born in an era when bond yields were comfortably high, inflation was low, and the average lifespan was shorter. Back then, a 30-year-old could safely assume a 30-year retirement horizon, and a 65-year-old could count on a modest 20-year payout period. Fast forward to 2024. The average life expectancy in many developed countries now exceeds 85. Bond yields have slumped to historic lows, and the global economy is wrestling with unprecedented monetary policy shifts. Those old rules no longer line up with the new reality. If you keep allocating based on a rule that was written for a different world, you're essentially navigating with a map that shows yesterday's streets. That mismatch is why a staggering 78% of retail investors admit they're not sure if their asset mix is appropriate for their age. It's not just a knowledge gap, it's a structural flaw in how we think about risk. The first major misconception is treating the 60-40 rule as a universal law. Imagine you're baking a cake, and the recipe tells you to use exactly 60% flour and 40% sugar, no matter what size of cake you're making. That would work for a small cupcake, but as the cake gets bigger, the proportions need adjusting to keep the texture right. Investing works the same way. The flour stocks provides growth, while the sugar bonds add stability. But the right ratio depends on how much rise you need, how long the cake will sit in the oven, and how sensitive you are to a sudden collapse. A 25-year-old with a high-earning career and a low debt load can tolerate a much higher stock exposure than a 55-year-old who is nearing retirement and needs to protect a dwindling nest egg. Yet the 60-40 rule forces everyone into the same mold, ignoring personal cash flow, health outlook, and even psychological comfort. This one-size-fits-all approach is the root of why most investors end up holding the wrong balance. Now let's talk about age-based allocation. The classic advice says, your age in bonds, the rest in stocks. So a 30-year-old would hold 30% bonds, a 70-year-old would hold 70% bonds. On the surface, it feels logical. Older investors need safety, younger investors can afford risk. But look closer. That rule assumes two things. First, that bond returns are stable and positive. Second, that risk tolerance drops linearly with age. Neither holds true today. Bond returns have been squeezed by years of near-zero interest rates. In many cases, a 10-year treasury yields less than 2%, and after inflation, the real return can be negative. Meanwhile, volatility in the stock market has become more nuanced, with technology-driven growth sectors offering outsized upside even for older investors who can tolerate a bit of swing. Moreover, risk tolerance isn't a straight line, it's a curve that can dip and rise depending on life events. A 45-year-old who just paid off a mortgage may be more comfortable with stocks than a 55-year-old who just faced a medical emergency. The age-based formula flattens these peaks and valleys into a bland gradient, leaving many with a bond weight that is either too low to protect against market downturns or too high to capture growth. A surprising fact that most people overlook: the relationship between bond duration and interest rate risk is exponential, not linear. When interest rates rise, long-duration bonds lose value faster than short-duration ones. In the past decade, central banks have been cutting rates, making long-duration bonds look safe. But the pendulum is swinging back. If the Fed hikes rates by just 1%, a 20-year bond can drop 15–20% in price. That's a massive hit for anyone holding a large bond allocation as safety. Yet many retail investors still load up on long-term treasury bonds, thinking they're the ultimate shelter. The reality is that in a rising rate environment, bonds can become a liability, eroding the very capital you intended to protect. This hidden risk is why a static bond allocation can be more dangerous than a dynamic one that adjusts duration based on the interest rate outlook. Let's bring this to life with a real-world scenario. Meet Sarah, a 38-year-old software engineer. When she started her first job, she followed the standard 80-20 stock bond split recommended by her employer's 401k plan. Over 10 years, she contributed 15% of her salary, and her portfolio grew modestly, about 5% a year after fees. When the pandemic hit, stocks plummeted, but her bond portion held steady, cushioning the blow. Fast forward to 2023, Sarah's employer changed the default to a 60-40 split, citing modern portfolio theory. She didn't adjust her contributions. The system automatically shifted more money into bonds. At the same time, the Fed began raising rates to combat inflation. By the end of 2024, Sarah's bond holdings had lost 12% in market value, while the stock portion rebounded strongly, delivering a 20% gain. The net result? Her overall portfolio lagged behind peers who kept a higher equity exposure and used short-duration bond funds. Sarah thought she was being more conservative, but the shift actually reduced her growth potential and exposed her to a different kind of risk. Her story illustrates how a seemingly harmless allocation tweak, guided by a generic rule, can derail long-term wealth building. Contrast that with Michael, a 58-year-old small business owner who thought he should be all bonds as he neared retirement. He followed the age and bonds rule and allocated 70% of his $800,000 portfolio to long-term corporate bonds, with the remaining 30% in a handful of dividend stocks. When interest rates started climbing, his bond holdings slumped, and the income they generated barely covered the inflation-adjusted cost of living. Meanwhile, a modest 30% stock allocation barely kept up with the market's upside. By the time Michael decided to rebalance, he faced a significant shortfall that forced him to sell assets at a loss to meet cash flow needs. If he had used a more nuanced approach, perhaps a laddered bond strategy with varying maturities, or a mix of inflation-protected securities, he could have mitigated the rate rise impact while still capturing some growth. Michael's experience shows that age alone doesn't dictate the right mix. The type of bonds, their duration, and the broader macro environment matter just as much. So how do you rebuild a proper balance that actually fits your life stage? The first step is to discard the age and bonds myth and replace it with a needs-based framework. Start by estimating your future cash flow requirements, how much you'll need each year in retirement, accounting for healthcare, housing, and lifestyle. Then calculate the buffer you need to protect against market downturns. This buffer is often expressed as a percentage of your total assets that you keep in low volatility, liquid investments. For many, a 10-15% cash or short-duration bond buffer is sufficient. The remaining assets can then be allocated based on a risk-adjusted growth target, not a simple age number. If you have a high income and low debt, you might allocate 80% to equities, even in your 50s, because you can afford to weather volatility. If you're close to retirement but still have a sizable pension, you might tilt more toward bonds, but choose short duration or inflation-linked bonds to avoid the rate risk trap. Another key element is duration matching. Think of your retirement horizon as a timeline, and your bond holdings as a series of stepping stones that need to land exactly where you plan to step. By laddering bonds, buying securities that mature at staggered intervals, you create a natural flow of cash that aligns with expected expenses. For example, a 30-year-old could buy a 5-year, 10-year, and 15-year bond, each representing a slice of future cash needs. As each bond matures, the proceeds can be reinvested into longer-term bonds or shifted into equities, depending on the market environment at that moment. This approach reduces exposure to interest rate swings because only a portion of the portfolio is locked into any single rate environment at a time. Diversification beyond the simple stock-bond dichotomy also matters. Real assets like real estate, investment trusts, rates, commodities, and even infrastructure funds often have low correlation with traditional equities and bonds. Adding a modest 5-10% exposure to these assets can improve the risk-adjusted return of the whole portfolio. Consider the analogy of a sports team. You wouldn't field only forwards because they score the most points. You need defenders, midfielders, and a goalkeeper to keep the team balanced. Similarly, a diversified portfolio can weather sector-specific shocks better than one that leans heavily on just two asset classes. Technology has also opened doors to more granular allocation. Robo-advisors now offer dynamic risk models that automatically adjust your equity-bond split based on market volatility, economic indicators, and your personal risk tolerance. These platforms use algorithms that can, for instance, reduce equity exposure when the VX spikes above a certain threshold and then gradually increase it as volatility recedes. While no model is perfect, the ability to respond in near real time to market conditions is a far cry from the static allocations many investors still cling to. Now for the twist that most financial newsletters don't want you to hear. The optimal allocation for many investors may actually be more equity-heavy than the traditional advice, even as they age, provided they incorporate a disciplined withdrawal strategy and use bonds primarily as a liquidity tool rather than a safety net. In other words, bonds shouldn't be the cushion you sit on, they should be the bridge you cross when you need cash. By keeping the bulk of your portfolio in growth-oriented assets and only pulling from a small, well-managed bond or cash reserve when you need to fund expenses, you let the higher return portion compound longer, dramatically boosting your retirement wealth. This approach flips the conventional wisdom on its head and explains why some retirees in their 70s still hold 70% stocks and live comfortably. To illustrate, picture a couple, the Lees, who are 72 and decided to follow the age and bonds rule. They kept 70% of their $2 million portfolio in bonds, earning an average of 1.5% after fees. Their annual withdrawal needed to cover living expenses was $60,000. Because bond yields were low, they had to dip into the equity portion each year, gradually eroding the growth engine. Over a decade, their portfolio shrank to $1.4 million, forcing them to cut back on travel and hobbies. By contrast, a similar couple, the Parkers, kept 70% in a diversified mix of dividend-paying stocks and growth funds, and only 10% in short-term treasury bills for cash needs. They withdrew the same $60,000, but because the equity portion continued to grow at an average of 5%, their portfolio actually increased to $2.3 million after 10 years. Their higher equity exposure didn't expose them to ruin, because they used a systematic withdrawal plan that limited how much they sold each year. The lesson? Bonds are not the universal safe haven. They can become the drag if you let them dominate your asset mix. What does this mean for the average retail investor scrolling through endless articles about the right age-based split? It means you need to stop asking, what percentage of bonds should I have at my age? And start asking, what cash flow needs do I have, what duration exposure can I tolerate, and how can I keep my growth engine running as long as possible? The answer will vary from person to person, but the underlying principle is the same. Allocate based on needs and risk, not on an arbitrary age number. Before we wrap up, here's a retention bump. Did you know that the average 40-year-old investor in the United States holds only about 15% of their portfolio in cash or short-duration assets, even though financial planners recommend at least 20% for liquidity? That gap alone can force premature sales of equities during market dips, locking in losses and derailing long-term growth. It's a silent killer that most people never notice until it's too late. And another, if you could boost your retirement savings by just 0.5% a year through smarter allocation, over a 30-year horizon, that's the equivalent of adding an extra $100,000 to a $500,000 portfolio. Small tweaks, massive impact. So, where do you go from here? Start by reviewing your current allocation with a fine-tooth comb. Identify how much of your bond holding is long duration versus short duration. Ask yourself whether those bonds are truly protecting you or merely sitting idle while rates rise. Then map out your expected expenses for the next 5, 10, and 20 years. Build a ladder of bond maturities that line up with those cash flow milestones. Finally, consider adding a modest slice of real assets or alternative investments to lower overall portfolio volatility. Remember, the goal isn't to eliminate risk entirely. That's impossible. It's to shape the risk so that it aligns with your life story, your health outlook, and the economic environment you're living in. By moving away from the one-size-fits-all age rule and embracing a needs-based, duration-aware strategy, you give yourself a better chance of turning that ticking time bomb into a steady, reliable engine for wealth creation. If you could redesign your portfolio from scratch today, knowing what you now know about age-based allocation, what would be the first change you'd make?